Now for, I don't want to say the graveyard shift, but the final speaker for today to join us is Ben Fitchu, who's a portfolio manager at Ardevra Asset Management. And just to double check that Ben is live and online with us this morning.
I am live and I am online, albeit by my mobile. So hopefully that is coming through okay.
Yeah, I can hear you okay. Hopefully the audience can. The guys were giving me signals back here to hold Tony on because you were having some tech issues. So apologies if that is on our side. But I think we'll be able to get through the session okay. In fact, I have the slides here, which I'll share as we go through some of the Q&A with Ardevra. As you know, the sessions with Ardevra are usually different to everybody else, and maybe that is quite fitting, seeing Ardevra manage money very differently to everybody else, with a strong focus on CEO behavior and how that may influence the behavior of investors as well as analysts. Ardevra kind of also build their portfolios from the bottom up, and what you end up is with quite a diversified portfolio of both value and growth names, and importantly, they limit the weighting to all these stocks, so they all have a similar weighting. So you'll see kind of oscillating between 1 and 1.5%, which kind of removes their own internal biases, which is quite an interesting reflection to make. Also, Ben joined Rob Johnson for our global perspective. I think that was a week or two ago, talking about market surprises and how the market reacts to some of these earning surprises from companies. And if we've got time, I think I'll maybe see if I can get a highlights package from Ben at the back end of our session this morning. So Ben, just to bring you in here quickly, I'm going to ask the question and see if I can get a slide up for the viewers' sake. As bottom-up stock pickers, I mentioned you're able to hold both growth and value. I guess this is a function of the environment as well as your stock picking process, but maybe you can just reflect and provide some color for those that have dialed in, how that tilt between value and growth may have advanced during the last quarter.
Yes, I suppose the sort of the biggest changes and most sort of relevant to your question are that we've found more interesting management behavior in kind of value type stocks in the last I would say six months, and then particularly in the energy sector, which is has been an interesting one for us over the years, where particularly the last couple of years we had a stance on responsible investing which initially excluded them, but where we have evolved our thinking a little bit here. But in particular, I suppose the most important sort of shift in the latter part of the quarter was that we bought an interesting set of E&Ps and LNG skewed names for the portfolio. And I think that energy and in industrial commodities in particular are flagging significantly in our methodology for our process of looking at unusual CEO behavior. You can see there that in a wide range of commodity businesses, that CEOs have been repeatedly shaken and scarred by repeated shocks, of which COVID and then the supply shock from the unfortunate Russia-Ukraine war has really led to a very, very tight supply, and also extremely chastened management behavior who are not focused on increasing supply into an increasingly benign sort of pricing environment. So to answer your question, you can see from that chart that the portfolio is tilted more towards value stocks, and really, in the recent quarter, the interesting main ones I would say fall in the energy sector. But there are some, we would say, signs of essentially really beaten up growth stocks now becoming value stocks. So we're just starting to tiptoe into this area, I would say, so dipping our toes in the pool of sort of really scarred, derated growth stocks. So we bought Meta and we bought Netflix recently, where we see an unusual amount of anxiety around businesses that are actually what we would say are pretty difficult to break. Fundamentally, they may have had a difficult environment around them over the last year or so, what with COVID rolling off and sort of some emergent new business models stealing a little bit of growth, but fundamentally very strong businesses with a lot of anxiety around them and management behavior that suggests that they are reacting to some disruption. So some interesting shifts in the value area, I would say, for the portfolio, to answer your question.
Thanks very much, Ben. Yeah, you brought up energy briefly there. I know you have a responsible investment team that look at energy stocks, and you did change your stance in terms of how you define a responsible investor. And you guys did bring out a white paper as well as a video on the Ardevra website. So if you want to read a little bit more about that, I encourage you to go have a look. It's a fantastic video with both Ben and Jeremy Lang, his co-founder and partner there at Ardevra. So just moving on, in the interest of time, Ben brought up a table here showing the key contributors for the course of the last quarter. You can see a fair amount of growth names there at the top, but that doesn't make for obvious reading. So maybe you can describe a little bit to the audience in terms of where this contribution came from and why are we seeing those names that where maybe the stocks had come down a bit.
Yes. So the tricky thing about these tables is, alas, that for our fund, which has a lot of small positions, very diversified, as you said at the beginning, is that we may own some stocks under the benchmark weight, like Apple, Amazon, Alphabet, Tesla, and Microsoft there, and that if they're particularly those mega caps, if they have a difficult quarter, then because of the size and impact they have on the benchmark, they can appear as contributors because essentially we're underweight. So one of the general contributors to our quarter so the last quarter was our underweight to the mega caps, and so stocks that we own there appear to contribute even though they've done worse. Do you know what I mean? So it's a slightly difficult table to read in the first half, but essentially that's why those feature there. And then the bottom half is slightly more interesting, I would say, which shows what's going on in the market last quarter, which is the market was definitively worrying about a recession. It was worrying about cyclical areas. It was worrying about tech and the consumer. And then it definitively bought into lagging, predictable businesses, I would say, in a bunch of different industries. So you can see BAE, which is a defense name, which is very sort of low sort of volatility business model, very predictable. And McKesson similarly is a healthcare distributor. Surface Corp is actually it's a funeral parlor business in the US, and unusually, alas, unfortunately, predictable business model, you would say. AutoZone, which is a defensive retailer, which basically does auto parts for DIY and for garages who mend your cars. So it's, again, very predictable. And Amdocs, similarly, a highly predictable business model that essentially is business process outsourcing. So really that table has a bottom and a top half story to it, if you like. The real story in the market, I say, that is interesting is that the market is worried about the effect of inflation and a recession coming, and that is coming out through more predictable businesses being well rewarded, I would say.
Mm-hmm. I just want to use this opportunity while some of those sort of tech growth names on our screens. You mentioned adding, was it Netflix recently?
Yep.
So I was just, looking at some of the numbers. I think Netflix still, the subscriber base is the largest in the world of those streaming companies, maybe 280 million. I stand to be corrected. So still higher than Amazon, and I think it's Disney. Is it Disney Plus? Excuse me for not getting that correctly if I got that wrong. But the basis for going in on someone like Netflix is that, I mean, they lost something like 1 or 2 million subscribers out of this 280 million. Is that investor anxiety coming through, or is it more on the earnings side and just underestimating the ability to create earnings?
Well, it's basically a combination of for us, CEO behavior, how has managed behavior reacted to a number of stresses on their business model. So the stresses are, you would say, the sources of trauma. One is the COVID, basically, essentially rolling off. So it had an extremely unusually easy environment during the sort of peak pandemic period, where people obviously were trapped indoors and needing the streamers, and then that has also sort of encouraged lots of other business models to go into that area, of which Disney Plus was accelerated. Certainly in our house it was accelerated, but I think more generally the idea was that Disney ran to the direct-to-consumer model slightly quicker because of the necessity there. So the worry in the market is essentially capital crowding, so lots of people adopting the same business model, and that it's basically running out of growth. And so you can see that anxiety in the share price that has fallen a long way for such a business model with such a strong user base. but management have reacted, and Netflix's history is sort of replete with them pivoting their business model with lots of anxiety around it, and that they have been effective at turning around the business a number of times in response to changes in their environment. And so the news that they are bringing out an ad-based lower cost lower cost subscription stream has been treated with a lot of anxiety in the market, but it actually looks like a relatively low risk maneuver to us. So for us, it's that pattern of share price stress, worries about the viability of the business model, but it's a fundamental of a very strong business. To your point, we've got a very big addicted user base. They've got extremely big library. They create their own content now. It is not an existential threat what they're facing now. So we see the adaptation, and we're buying at the high anxiety.
Yeah, I think it's an interesting point. That lower cost subscriber option they're looking to do might introduce something like adverts, and maybe that's where some of that fear comes from. But I think YouTube, maybe even Instagram and WhatsApp have kind of negated that risk around advertising, where the market was like, hold on, this is a negative step. And
no, exactly. It's the nervousness is to your point. You're absolutely right. They're nervous because it's a change, but really it's the right kind of reaction. And there's plenty of outside reference points to support that ad-based models are actually perfectly viable. But the combination of the investor stress and they didn't, the user base didn't grow in the way that the analysts had hoped for in the last quarters has led to what we would say. So from a behavioral perspective, that change is seen as risky because of the environment that they've been in, rather than as a de-risking maneuver. And we see that kind of thing a lot. If they weren't adapting, we would be much more concerned. So that's how anxiety tends to infiltrate investors' perceptions of risk. A risk lowering maneuver is seen as risky.
Okay, well, there'll be a fascinating stock to watch going forward. I think one of the British PMs even admitted in Parliament that they share their Netflix login with 5 family members around the country. So I think that's something they're looking to clamp down on as well. But in the interest of time...
Sorry. Oh, yeah, absolutely. So I was just going to say that is a pattern well trod by Adobe a long time ago, and they had lots of people using copies of their software. So if you're able to do that, you can monetize a much wider user base. Sorry to keep lengthening the answer.
No,
but I think
no problem. I'm just looking at the clock. I know we have a couple of minutes. I don't know. So I've just moved on to the key detractors in the last quarter. If you have any high-level comments on some of those names you might see there.
So what you can see is that, again, those are value names, and the main, actually, the important things to note is that the market's starting to worry about essentially the effect of inflation on rates, and then a knock-on effect of a recession, and that hits cyclicals, particularly some of the commodity names. You can see Freeport-McMoRan, which is a copper miner, Alcoa, which is aluminium, First Quantum, which is copper again, and so you can see a bunch of cyclicals there. SK Hynix, which is essentially commodity memory semiconductor, and so really that was the main source of detraction for us in the last quarter. Still think there's very interesting supply setup there, but it could get interrupted on the demand side from any kind of slowdown or recession. So that's the worry that has hit the market last quarter.
Okay, thank you. I know we had someone on our local workshop a couple of days ago who mentioned China's inflation being a little bit or manageable than the rest of the world, and potentially reaching some sort of infrastructure spending phase, which could be supportive of commodity prices. But I know you guys don't like to make too many macro forecasts, so I'll move on from there and leave that parked for now. The title of your presentation is Leaning on Our Experience. So I guess during what has been quite a difficult period for Devra, given your quite high standards over the course of the last sort of decade or so, how do you put your performance into the context of your longer term experience?
Well, obviously, poor performance has always makes you think about, what's going on. We have seen previous bouts of underperformance from the way that our process works, particularly, as a team. But Jeremy and Bill, obviously, who are a little bit older than me, shall we say, have experience going back to the early to mid 80s on it. And so we have seen previous bouts when our process, which focuses on understanding error in humans, investors and analysts and CEOs, and we particularly try to find surprise in stocks that then drive share prices up. There are periods when that surprise does not lead to reward, and that breaks down. And this is one of those periods we're seeing last year and then a little bit of this year, where macro factors basically are interfering with the normal way that our investment process derives alpha. And so we have seen this kind of thing before. 1987 period in the 90s, 1998 when there's LTCM, a little bit in post-TMT bubble, a little bit in the financial crisis after that, 2016 and 2018. So I know I've listed a number of years there, but and that we basically believe and have the evidence that our process works 4 years out of 5, and you do get difficult periods where surprise doesn't lead to reward, and it's usually when there's a lot of macro noise swamping fundamental bottom-up surprise. And so our belief, I think, is well grounded that it doesn't last forever, and that the process goes through these sort of difficult periods, and then you come out when things are slightly more stable.
Great, thanks, Ben. I know that that concept of surprise and reward is largely what Ben focused on in his chat with Rob Johnson a couple of weeks ago. Absolutely fascinating topic. And I encourage you to go have a look at that video. I think it will be on our YouTube channel, or just get in touch with your Ned Group Investments Relationship Manager if you'd like a copy to that webinar. But Ben, that's all we have time for today. Our South African audience are craving their lunch. The UK and Europeans, they're 11 o'clock tea. But yeah, thanks very much again for joining us, and we look forward to catching up with you soon.